What is leverage trading? When you register on a crypto exchange and buy Bitcoin, you are participating in what's called the spot market. Here you can buy or sell Bitcoin directly. For example, if you have $1,000 and buy Bitcoin with it, the value of your investment changes directly in line with Bitcoin's price movements. If Bitcoin's price rises by 5%, the value of your investment also increases by 5%, making your total worth $1,050. Leverage trading, however, works differently. Instead of buying Bitcoin directly, you often trade in futures contracts. These are agreements to buy or sell a specific amount of Bitcoin at a set price on a certain date. While the prices on the spot market and futures market are usually very close, leverage allows you to trade with borrowed money, amplifying both your potential gains and losses. For example, if you have $1,000 and use 5 times leverage, you can control $5,000 worth of Bitcoin. If Bitcoin's price increases by 5%, your profit would not just be 5% or $50, but 25% or $250 thanks to the leverage. How does leverage trading work? Futures trading uses leverage so that profits and losses are amplified. For example, if we use 5 times leverage, our gains and losses will always be 5 times greater than if we were simply trading Bitcoin without any leverage. Leverage is achieved by borrowing money from the trading platform. If I deposit $1,000 and use 5 times leverage, I'm trading with a total of $5,000. My $1,000 are deposited as collateral to cover any losses. And with the 5 times leverage, I now have access to 5 times the amount, for example, in this case, $5,000, which I can trade with. You also have to pay fees on this borrowed money, which are automatically collected depending on how long you keep a position open. These are called funding fees. This amount depends on the position size and the current market conditions. Other than that, there are the typical order fees that occur when opening and closing positions. With leverage trading, we can also now profit not only from rising prices, but also from falling prices. Long position. Betting on rising prices. Suppose you deposit $1,000 as collateral and use 5 times leverage to control $5,000 worth of Bitcoin when its price is $50,000, giving you 0.1 Bitcoin. If the price increases by 10% to $55,000, the value of your 0.1 Bitcoin would rise to $5,500. After selling, you repay the $5,000 you borrowed, leaving you with a $500 profit. Combined with your original $1,000, you now have $1,500, meaning a 50% profit on your initial $1,000 investment, even though Bitcoin's price only rose by 10%. Short position. Betting on falling prices. If you anticipate a drop in Bitcoin's price, you can short it. You deposit $1,000 as collateral and use 5 times leverage, borrowing 0.1 Bitcoin worth $5,000 when the price is $50,000. You sell the 0.1 Bitcoin for $5,000 and wait for the price to drop. If it falls by 10% to $45,000, you can buy back the 0.1 Bitcoin for $4,500, return it to the platform, and keep the remaining $500 as profit. Including your initial $1,000, you now have $1,500, making a 50% profit even though Bitcoin's price fell by 10%. What are the risks of leverage trading? Trading with leverage naturally always involves risks that you should be aware of. It can, of course, happen that the price does not move in the desired direction. And just as profits are multiplied, losses are also multiplied. Let's say we take $1,000 and bet on rising prices with 5 times leverage. If the price goes up by 10%, we make a profit of $500, resulting in a gain of 50%. However, if the price falls by 10%, we incur a loss of $500, losing half of our initial amount. If we take this to an extreme and use 100 times leverage, we would double our money if the price only increases by 1%. But if the price decreases by 1%, we would lose all of our invested capital. A common question is, can you lose more money than you have invested? Can you actually lose the borrowed money? This is not possible with a vast majority of platforms, including Margex Exchange. You can only lose a maximum of the amount that you have invested yourself, meaning you cannot get into any debt. If a position goes so far into the red that the collateral you have deposited can no longer cover the losses, the platform automatically closes the position. This happens at the so-called liquidation price. When you open a trade, this price is displayed, and it is the price at which the position would be automatically closed, causing you to lose your entire stake for this trade. However, you don't have to let it get that far and reach this liquidation price, as you can also protect yourself beforehand by setting a stop loss. A stop loss ensures that the position is closed beforehand at a certain loss so that you can limit your risk. For example, if I enter a position with my own $1,000, regardless of the leverage, I can set it to close automatically if I lose $50. This way, I cannot lose more than these $50 in this trade, allowing me to limit my risks. We will discuss tools like stop loss and take profit in more detail in our next guides. Thank you for watching.